recipes for technical trading success in Cook's Kitchen.
Hey everybody, welcome back to Cook's Kitchen. Today's topic is about the race to price in the recession. Everybody thinks a recession is coming. I'm going to show you why it's on hold and what you should be buying. All right, so all this week I've been doing content for Zacks Ultimate subscribers, and just this afternoon I did a presentation for our Zacks strategists on when is the recession coming, because it seems like every economist wants to call it now. The title today was Economic Hurricane Coming, and I've got a cool little model here I want to show you about what goes into a recession forecast recipe. But first, let's where is the idea of an economic hurricane coming? Well, I'll use there's the Little Mermaid. Stand fast, secure the rigging. So that was the call was actually from Jamie Dimon about a week ago. He said, "Get ready for the economic hurricane. It's a coming," and I don't agree. There's a lot of models out there forecasting it. If you just listen to a big bank economist, they're gonna plug in interest rate forecasts going out and how that might impact the economy 6 to 12 months out. A lot of them have a recession forecast in the second half of 2023, just based on interest rates. Obviously, Jamie Dimon's calling for something more dramatic. I don't see it. So let's take a look at some of the charts that I've been showing people about why you wanted to buy this market. So here's the S&P. Why was 3,800 so interesting? People who follow my technical work know that I do not use trend lines. I think trend lines are mathematically absurd for many reasons. If you don't know what I mean, just Google or YouTube. Trend lines are mathematically absurd, and you will find my video treatise from over 5 years ago where I explain why that. So what I like to do, though, is talk about price memory. And for that, all you need is a nice straight horizontal line. So what is price memory? It's where the market consolidates and congests and digests gains for a period of time, several weeks, several months. So why was 3,800 important on the S&P? Because you go back to Q1 of 2021, and the market spent some significant time between 3,750 and, call it 3,950 on the S&P. So this is price memory. This was consolidation. It turned out to be support, as it should. Let's see how this shows up for the NASDAQ. See, the market is rushing to price in the probability of a recession. Some people think a recession's already here. I don't, and I don't even see one in 6 months. But when your probability of recession rises to 30, 35%, as mine did, then the market weights that differently. So, all right, so what did the NASDAQ 100 do? The NASDAQ 100 came down to 11,500. Gee, let's look back in history and see where that was important. 11,500 is the middle of this 2-month consolidation, which was in Q3 of 2020. So remember, back here is the Corona crash that takes the NASDAQ 100 down to 7,000. We rebound quickly as we realize, the software is still king, right? Because what we saw was 10 years of digital transformation in 10 months. And so we digested these gains at new highs in the NASDAQ of 11,500 and got through earnings season, and the revenue forecasts were strong. So we bust out of that and vault higher. Now, we did get into a bit of a bubble, and so we had to retrace, and the place that shows up the biggest is in software. So we'll go to the IGV, which is the ETF that represents the large cap software. So Microsoft and Salesforce are going to be heavily weighted here. What's interesting here, you talk about price memory, is software was in a bubble. So what do bubbles do? They pop eventually. And pop this one did. and this thing took out the Q3 consolidation that found support in the Nasdaq, and the IGV went all the way back to, we'll call this 260 on the IGV. That was the peak before COVID, before the Corona crash. That's where software was. So it's just it's almost ridiculous that we had to go all the way back there. But that's why I was saying, you want to be a buyer of software here, and so we were buyers of Shopify, Square, CrowdStrike, and then related NVIDIA and AMD. Now, you may think of NVIDIA and AMD as purely GPU chip companies, but software is extremely important to what they do. It's very closely tied, and they create hardware software stacks. For instance, the one I love to talk about is the robotics platforms. NVIDIA builds a kit, the Jensen, is it AGX? I forget, but they basically build a hardware software stack that corporations can buy and build their own robotics automation systems for a factory, for a hospital. Well, Lisa Su at AMD, number 2 in the game, right on Jensen Huang's heels, just unleashed their own robotics platform for corporations to do the same. All right, and so the Zacks is held up better because demand is much more clear and visible going out for semiconductors, despite the supply chain, despite Ukraine, clamping down on, the rare minerals needed. So that's why I was a buyer of semis. Okay, let's talk about the recession recipe. And so what I did is I turned this pie chart into an Excel spreadsheet. So I've got 7 factors here that could tip the consumer to tip the economy into recession. So that's the way I'm structuring this. The linchpin is consumer confidence and consumer spending. That's the linchpin of whether we go into recession or not. So what are the dominoes that tip the consumer? Is it going to be inflation and oil prices? Is it going to be corporate spending? And related to corporate spending would be layoffs. Is it going to be the yield curve? Is it going to be the housing market? War in Eastern Europe or China? You can weight these however you want. These were somewhat arbitrary the way I put these together, although I did mean for war in China to have less weighting and things like corporate spending and layoffs to have a higher weighting. This is the kind of model you want to create for yourself, and you could just dial up a spreadsheet like this. And my analysis moved me to a 35% chance of recession in the next 6 to 12 months. But I'm not at 40%. Like once I go over 40%, then I start getting real cautious. And I'm not. I'm just like normal. There's a lot of things happening. Mortgage rates just rose. So let's just talk about housing itself. My colleague Tracy Reinick tracks the home builders religiously and the inventories. And I just had a discussion with her today. She sees that the housing market prices are very sticky. We're no longer in the days where you have 16 bidders who end up paying 20% more than the asking price for a house, although that's still going to go on in some hot markets. But in the hot markets, let's say in Austin, Texas, you're going to have, 3 to 5 bidders, and the seller is probably going to get their asking price. So, and the demographics support that. So even with mortgage rates moving to 5.5%, the demographics of housing demand, family formation, millennials settling down for the next 5 years, and it's just not going to kill the housing market. So that's strong. Is inflation going to dent the consumer? Right now, it doesn't appear so. We're gonna adapt to $6 gasoline too. So, the thing is, the Fed could end up flinching on all of this, right? They've taken rates. They're going to jump rates probably another 100 basis points at the next 2 meetings, and that's already priced in. See, it's the unknowns that get you with an economy, and the market is already pricing in all the interest rate hikes. Housing is stable. We're pricing in inflation, and so then the other wild card would be to look at layoffs. So you got to look at what are we hearing about the job market? Hey, jobs are still plentiful, and you just got to get people off the couch and go apply for them. Is basically where we're at, because there's still $2 trillion in cash sloshing around from pandemic stimulus that keeps people from not being in a hurry to take the job for $20 an hour. So the things that concern, like, big retailers like Target warning, and paying $1 billion more for fuel costs. Again, that's already priced in. So much is priced in, and that's why the stock market, if recession fears heat up, this stocks could take another trip lower, but right now I think you're set up to be an active buyer of select growth names. We just bought CrowdStrike this week. We bought CrowdStrike after a great earnings report last week. I told my people, let's buy it under 170, and we got that chance even early this week. So on Monday. So let's take a look at Crowd. Just a dominant player in cybersecurity, and in particular endpoint security. I just did a video on it this week. You look up the top stock picks video. So here we are. This is a weekly chart. Endpoint security, if you don't know, is we've got all these devices, right? Everything's mobile. You need security for IoT at the edge of the cloud, and so CrowdStrike specializes there. All right, so build your own recession model. Look at the things that will really matter. So I would focus on the housing market, the job market, as early indicators of when the consumer confidence gets hit enough that they retract spending because they're tired of paying $6 for a gallon of gas, or $7 if you're in California. And so watch those things. If your recession probability goes over 40%, then you're a less active buyer of stocks. But I think we're going to have we're going to get the next earnings season is going to tell us a ton, and I think you want to buy stocks on sale even before then. So I've done a lot of content for subscribers and members of Zacks and my trading service Taser all this week. I did the Zacks Confidential on software and what you should buy there. We had our Zacks Ultimate Strategy session, which is just for Zacks Ultimate members. So if you want to learn more about the stocks that I'm buying and selling and what my price targets are and the moves I'm making, you can just check out a free trial of Taser. And you can do that by emailing ultimate@zacks.com. All right, cook her out. We'll talk to you next week.